summary, the ASA is weak, and without change, it will continue to decline, and the business valuation discipline will continue to decline. The ICPA ABV, they put on some good conferences, but there really is, to me, that I see, no clear engine for growth. The NACBA will grow in significance as a credentialing organization. They have more credentialed appraisers than everybody else combined. And I see that there's a need for consolidation among the VPOs, but I don't see a clear path for that happening at this time. So the demographics are changing, the profession is aging, and we're all trying to deal with it. The profession, as we know, is consolidating. In 1987, there were the big 8 accounting firms. Just a few years later, we're down to the big 4 accounting firms. So there was a rapid consolidation at the top with the biggest firms in the land. We now have the big 4. Accounting has become interesting to private equity investors. There are a number of private equity firms who have bought into significant CPA firms. They're listed on the slide. CBIZ is actually a publicly traded firm and has bought a number of CPA firms and perhaps a valuation firm or 2. But this is a trend that will continue. Alan Colton made this pretty slide. I won't read it to you because there's just too much here. But on the left side, he talks about the kinds of acquisition or M&A activity that's out there. He calls them the transformation archetypes. Then we have different kinds of mergers, different reasons for mergers, and lots of people playing in that game. This is even busier, but it'll give you some idea of what private equity, ESOPs, wealth management, and global firms are doing in the CPA space. That space is consolidating, and that has rolled over into the business valuation space. Until 2020, every acquisition or merger that I'm aware of is listed on this slide. There were 21. HLHC sold to private equity in 2005. Volumetrics sold about that year, and we put an ESOP in at Mercer Capital in 2006. Lots of things have happened since then, and private equity has gotten interested in the business valuation space. VMG is an interesting situation. A healthcare valuation firm I think they're in their 3rd round of private equity financing at this point. Duff & Phelps, now Kroll, has several rounds of private equity financing. Since 2021, there have been many more acquisitions or mergers in the business valuation space. Willamette Management sold to Citizens Financial Group shortly after the pandemic was at least halfway in control. And you can see the list. Marshall and Stevens has bought several small groups, and some of these are actually financial forensics firms. But Mercer Capital bought Business Valuation Associates in late 2024, and this is the kind of consolidation that will probably continue in the space. According to Colton, there are some people that are more attractive than others to private equity or as a merger partner. Those with good margins, growing an attractive business mix, particularly the upper half of the accounting profession and the upper half of the valuation financial forensics world, might be seen as relatively attractive. Lower margins, little internal growth, and a commodity business mix is found in the lower half. Whether it's 50-50 or not, the point is the same, but these are not very attractive to private equity or as merger partners. 4 significant valuation firms have installed ESOPs. Comstock Advisors installed an ESOP many years ago. Mercer Capital in 2006, Empire maybe 3 or 4 years ago, and Prairie Capital some time ago. But these are firms that have chosen not to sell to somebody else, but to remain independent and employee owned. Consolidation is going to continue, although a great deal of consolidation has already occurred. There aren't many mid-sized valuation firms left in our space. There are some sizable financial forensics firms that may well find themselves as acquisition candidates over the next year or two. But private equity is going to continue. They've got a lot of money, and they see the margins and the cash flow in firms like accounting firms and valuation firms, so they like that. And some firms are just going to fade away. They'll just disappear. Or I used a number of years ago a slide where an older guy was shutting the door and locking the key and tossing the key away. You just shut the door and leave because there's no business there. We'll talk about that again in a few minutes. Some firms and some guys will find homes elsewhere. In other words, they'll nestle in with a handful of people into a bigger firm. The pandemic has helped in that regard because many more valuation firms are willing to accept remote or quasi-remote employees. But that consolidation will continue into the future. Wanted to talk a little bit about business valuation standards, and I'll give a second for this poll. Okay. I want to talk about standards because they become increasingly important with things like artificial intelligence coming into vogue. It won't, it's not clicking.
I think, yeah, if you click back onto your presentation, it's the poll question that throws it off. Sorry.
Is there a question?
No, you're good.
Okay. Well, USPAP came into being in 1989. Prior to that, there were no business valuation standards. USPAP came about because of the financial crisis in the mid to late 1980s, with so many thrifts and some banks that just lost control of lending and had large losses and failures, many related to real estate. And it was determined that the appraisal foundation should be created. It was, and the Uniform Standards of Professional Appraisal Practice were published for the first time in 1989. Generally, USPAP is updated every 2 years, but there was a gap since the 2021, the 2025 edition, 2024 edition is now effective and is out there. The International Glossary was published in 1989. Several of the valuation provider organizations were attempting to create a vocabulary, a consistent vocabulary. And that was the first effort of the American Society of Appraisers to create standards. But the International Glossary was created by the ASA, the AICPA, the CBV in Canada, and NACVA of the IBA, which is now absorbed into the NACVA, and was subsequently adopted by the NACVA. We now have the International Valuation Glossary Business Valuation published in 2022. The AICPA nor NACVA participated in this, although the NACVA did review it. But this glossary adds some definitions to the original glossary, introduced some new terms, and defines some valuation models. The ASA got into the standards business in June 1991 with our first standard. And by 2002, we had a little booklet published. It took a while to get that. In 2009, the standards were completely revised and updated, and they really haven't been changed since 2009. when the international glossary was taken out. But the ASA had a leading role in standards, but it's basically abdicated that role at the present time. The NACVA first published its professional standards. Actually, this slide didn't get updated, was 1993. And I'm not sure what happened there. They have been updated several times since. These are the professional standards of NACVA. And the NACVA has done more than anyone to compare its standards to other organizations. And you can see that on the website. The AICPA generated standards, valuation services number 1 in 2014 and in 2007, and it has not really changed since then. The IVS published standards in the mid-1980s and international valuation standards, and they considered that they were publishing standards for the rest of the world. The IVSC has always been underfunded, and they have a big goal of establishing international standards. The latest standards are effective 2025 with early adoption encouraged. So it's now past January 2025. One of the issues in standards is that they're supposed to be principles based. USPEP standards 3 and 4, standards rule 3 and 4 and 9 and 10 have a 20 of what I call musts. In other words, where the appraiser must do the following things. And there are several lists following some of the musts, but 20 musts. The ASA BV standards have 58, the NACVA standards have 20, and the AICPA standards, Statement of Standards on Valuation Services, have 4. There are some shoulds, but they don't rise to the level of musts. Compare that to the international valuation standards, which have a total of 182 musts. These are not principles-based standards. They're trying to tell people how to value companies and will limit their applicability in the United States. So predicting just a little bit, the IVS won't be adopted in the US for the foreseeable future. There's a better chance for conformity for BV standards within the United States, and USTAP will continue to be the most widely accepted standards in the United States. I wanted to talk a minute about artificial intelligence because this is something that I haven't really addressed so far. The question we ultimately have to ask in terms of business valuation is, how will artificial intelligence be reflected in business valuation? And to me, that is fairly straightforward. Ultimately, the impact of artificial intelligence will be the result of what it does and how it impacts companies in terms of increasing cash flow, increasing the growth of those cash flows, and or decreasing risks. Because you remember the Gordon model, value is equal to expected cash flow divided by R minus G. Those are the three key elements of value. We'll touch on those again in a minute. To prepare for this, I had one of our folks ask one of the AI programs. I said, what are the 10 best uses for AI in business valuation? Now, I'd like to tell you that I wrote all this, but predictive analytics for financial forecasting. There's some thought that AI might be better at forecasting, financial forecasting, than human beings, because it might be able to look at more information than the humans can and take more into account. Market sentiment analysis. This one surprised me, but go out there and take a look in a particular industry and gauge market sentiment. Automated comparable company analysis. I'm a little concerned about this, but AI can scan financial companies looking for comparability. applying algorithms. If by the way, if you're using AI and they're using algorithms, you better have some idea of what those are. But there's some thought that the process that has been time consuming can be automated or done more rapidly with the use of AI. Risk assessment and risk management. There's some thought that AI models can look at more things than a human can and give a better assessment of risk and management. We'll see about that, because I'm going to make my own investment decisions. Thank you. Asset and intellectual property valuation. Perhaps they might value intangible assets and intellectual property and other patents and other assets, but this says, AI says, this improves the accuracy of valuation for tech firms or firms with significant intangible assets. Well, I don't know. Fraud detection and due diligence in the financial forensic area. Perhaps it can help identify fraud, but once again, an appraiser or a financial analyst must be very careful if AI has been used. Integration of non-financial data. Maybe AI can look at things, look at more data and integrate it into the valuation with ESG factors. I'm not hearing very much about ESG anymore, but we'll see how that goes. Automated valuation models. This is scary, but calculate a company's worth using various methods. And it says these models save time and can generate quicker results, especially for smaller or privately held companies. Optimize merger and acquisition valuation. Perhaps private equity firms will use AI to add to their due diligence. Real-time data analysis and decision-making. So this came straight from AI in about 60 seconds. Is what it did. Now, the NACVA is responding to this artificial intelligence and machine learning by issuing its first NACVA advisory brief. It's called The Use of Artificial Intelligence and Machine Learning. I'm just going to mention a handful of words from this advisory brief. One is professional judgment. AI will not take the place of professional judgment. Ethical considerations. Verification and reporting notes that when incorporating AI and ML technologies, it's essential to verify outputs that are and make sure they're not misleading. And then finally, there's a caution to remain abreast of technologies and methodologies in this NACVA advisory brief. I found on the web that there are a number of ways that AI might impact business valuation: data aggregation and analysis, automated calculations, predictive modeling, comparable company analysis, some duplication, risk assessment, enhanced speed, improved transparency, access to complex data. And challenges: data quality, model complexity, and market volatility. So I think that it's out here. People are using it. Our marketing department uses AI to facilitate some of the marketing that we do. But have we created business value with it? I'm not sure. Maybe we're more efficient than we otherwise would have been. So maybe we'll generate more business as a result of this. But the impact of AI on Mercer Capital or your firm will be the impact that it has on increasing cash flow or increasing growth or reducing risk. I put together a couple of thoughts to conclude a short discussion of AI. And I will say that there's a need to understand what AI has given you. You ask it a question, it'll give you something. Make sure that you understand where it came from and what it is. Number two, you need to own any analysis. When I say own an analysis, I mean it's up here in your head. It's not in a machine somewhere. We cannot depend on AI to do your thinking for you. It may facilitate work, but don't quit thinking. Then use with caution in valuation and financial forensics, because watch out in court, because smart attorneys might use AI to twist you around and to damage you. But one real good use that we're already doing is using AI as a marketing tool. There's going to be a lot of talk about artificial intelligence. There's going to be a lot of talk about the magic of it, but it's not really magic. I was around when IBM created the supercomputers that were going to change the world. They did change the world. They changed the way that lots of companies did business. They made them more efficient, and that was reflected in value, but they didn't take over the world. They just helped businesses grow. Now, what is the future of business valuation theory? Some of you have heard me talk about this before, and I may sound like a broken record, but I have been saying some of the things that must happen in the future for years, and they haven't happened, or perhaps are beginning to happen at this point in time. We've already talked about 3 words summarizing the outlook for business valuation: cash flow, risk, and growth. Professor Damodaran has been talking about this in recent speeches and articles, and he says this. He calls it the IT principle. If it does not affect cash flows, including growth or risk, and therefore the discount rate, then it does not affect value. So I think Professor Damodaran is saying that the IT principle is dominating, or needs to dominate, the valuation business. What are the current trends in valuation theory? Well, I think there needs to be a better understanding of the levels of value and the reasons that they exist. I think there needs to be a growing recognition that you cannot use restricted stock studies and averages of restricted stock studies and pre-IPO studies to determine DLOMs, or marketability discounts. There has to be an increase in the use of quantitative methods. And I think in terms of a broader theory, it's been my experience that in recent years, many, if not most appraisers, have shifted from valuing equity directly to valuing the enterprise, and then subtracting debt and adding cash to get to the equity value. We also need a better understanding of what's called fair market value, because I see misunderstandings of that concept all of the time. I put together a diagram on the left saying that fair market value reflects the hypothetical negotiations of hypothetical willing buyers and hypothetical willing sellers. The concept of fair market value occurs at the intersection of where hypothetical buyers and hypothetical sellers would negotiate over price. And they negotiate based upon looking at expected cash flow, risk, and growth for the entity or the interest to be valued. I've seen too many valuations where either the hypothetical buyers or the hypothetical sellers did not appear in the negotiations. But they both have to be there, and an appraisal needs to reflect their hypothetical negotiations. I have used something called the levels of value chart for many years. I published the one on the left in 1990. And believe it or not, 1990 was the first year that basic levels of value chart was published. It was also published in a book that edited by Jim Zukin from HLHC. The levels of value chart today looks like the one on the right, in my opinion. Strategic control at the top, financial control and marketable minority, synonymous concepts virtually, and then non-marketable minority. But the question that most appraisers need to ask is, okay, we have these levels, so-called levels, and pretty much everyone agrees they exist. The question you have to ask is, why do they exist? And if we're right about the it principle, then the only reason the levels can exist is because of differences at those respective levels between expected cash flow, growth, or risk. The levels of value charts in some valuation texts still today try to discuss levels of value in terms of power or the relative power offered by an investment. But power is not it's not a useful tool in terms of valuation. It's very difficult to quantify power. In VAB6, in one chapter only, chapter 3, we find this chart, same as the one from the previous chart. And this is a little lengthy, but I think it's important because these words are in Pratt's VAB6. A given business or business ownership interest is likely to have more than one value at a given valuation date, therefore the levels of value. This multiplicity of values is attributable to the different perspectives from which one may consider the value of a business or business interest. Valuation analysts have traditionally referred to the available perspectives as levels of value. While a variety of charts have been offered by analysts and observers over the years, the Exhibit 3.2 includes the primary components that are common to all such charts. And this chart, by the way, is the one that I published. Not at least as early as 2000, maybe the late 1990s. It didn't get attribution in Pratt. But Exhibit 3.2 identifies 4 distinct levels of value and 4 discounts or premiums that relate the levels to one another. Now, this is what's important. The different levels of value and the corresponding discounts or premiums are rooted in differences in economic income, including growth and risk, from each different perspective represented on the exhibit. So this is the only place in VAB6 that acknowledges that these discounts that we all talk about are created by differences in expected cash flow, risk, and growth. The other levels of value chart in the book attempt to deal with the levels in the context of differences in power. My version of the it principle, I've been saying this for 2 decades. If it does not affect expected cash flow and or the growth of that cash flow or the risks associated with the expected receipt of the cash flows, then it does not affect value. I've been saying that for a long time. Now, the picture, just for kicks, many of you know that I like to play pickleball. Well, this guy is named Zeno, the guy on the left. My first name is Zeno Christopher. Well, the 2 Zenos, and Zeno's a little bit older than I am. He's an octogenarian. We ended up playing in a pickleball game together, and we took us a while to get our stride. We were down about 9-2. And we looked at each other and we said, we're just not going to lose this game. So we started playing like we knew how to play. And we ended up winning that game 11-9. So anyway, those 2 Zenos, that's one of the few pictures other than with my son and years ago with my father, where I've had 2 Zenos in one picture. My take on the IT principle has been published in Quantifying Marketability Discounts in 1997, in Valuing Enterprise and Shareholder Cash Flows, the Integrated Theory of Business Valuation in 2004. The second edition was published by Wiley with Travis Harms in 2007, and the third edition in 2021. But the IT principle is addressed considerably there. My predictions regarding valuation theory, the IT principle will prevail. It has to. Common sense has to prevail. The way that many appraisers do their valuation work has to change to conform to this principle. The old way of dealing with restricted stock studies and pre-IPO studies and junk will gradually die out, and quality of analysis must improve. And that's the quality of analysis by analysts, not necessarily artificial intelligence analysis. But those are predictions. I think the IT principle will prevail, hopefully while I'm still around. Now, how do we survive?
Hey, Chris, we had a question come in for you.
Sure.
It says, are there types of valuations or certain industries where there is a shortage of qualified valuation professionals?
I would say that there is a shortage of qualified valuation professionals nationally. And I don't know about any industry, but I mean, the fact of the matter is that's really a question that's leading to some, maybe suggest someone is thinking about specializing in an industry. The idea is that you go deep in an industry as opposed to broad to specialize. I think specialization is, I've talked about that in other talks, but this is uh, ran out of time on this one, but specialization is a key to gaining acceptance by potential clients, where they know you know what you're doing, and you can market to a broader group of people. I can remember in the 80s and the early 90s thinking, how do I get to the closely held companies out there? And we had lists from business journals and that sort of thing, and we would direct mail and market to those. But I specialized early on in the banking industry, and we knew where every bank was. And we knew where the banking conventions were. And so the most rapidly growing part of our business in the early part was financial institutions. And they still are a substantial part of our business. So I don't know that I can identify one, but find one and pick it. Probably not banks, because they're consolidating so rapidly. There's so few of them left. There were 12,000, 13,000 of them, I think, in 1980, and they're like 3,500 today. How do we survive in a consolidating profession? Alan Colton says that there are upper half and lower half companies in terms of growing and profitability, and in the mix of business that's attractive, that generates margins. So companies that are profitable and growing and have predictable cash flows are more attractive than companies that don't. So he calls those the upper half of the accounting profession, and he says the upper half is consolidating. The lower half is poor margins, little internal growth, commodity business mix, and you got to withstand the upper half. And these guys are not quite as attractive to investors as more attractive companies. So that's just an interesting dichotomy. But how can firms, if you're in the lower half, how do you get to compete with the upper half? Well, I think you got to run businesses better. They have to run businesses better and become more like the more profitable companies over time. Lots of small companies have major challenges and they need to be addressed. It's really important to fix the ownership structure in a business so that you can facilitate internal or external succession opportunities. And I would put management succession as well. I've used the concept since, well, for many, many years, of having a business ready for sale, whether it's time for sale or not. Ready for sale means that you've got your risks under control. You're expecting, your expectations are great. You got your attitude, you got your people in order, you're driving growth, and your comparisons look good. But ready for sale is an important concept. If anyone wants a PDF of some of those thoughts that are a few years old, let me know and I'll be glad to send them to you. But we're aging, and every company has the problem of attracting and hiring people, training people, getting them experience and credentialing them, and getting them to specialize and find a career path where you can return them. where you can retain them, because it is a difficult challenge to do this. We have been working on hiring young people for decades, and fortunately, some of those then young people are still with us. And but we had to get them, we had to train them. They had experience and credentials, and many of them have specialized. So with aging, I think younger people need to do that. The older people need to do these things in order to leave a path for the younger folks to grow. How do you increase value in a professional services firm? I probably sound like a broken record, but you increase cash flow and the margin, you increase growth, and you decrease risk. Maybe you increase cash flow with more sales. Maybe you increase cash flow with a change in your business mix. Maybe you increase growth with better marketing, better client retention, and client retention decreases risk. So these are the kinds of things that we need to talk about and focus on if we want to maximize the value of our firms. Like I say, it's the same for our clients that we value every day. Same for you, and the same for Mercer Capital. But that's how we value and maximize value. Now, in the time that we have left, I want to talk about two models. I want to call one the business model and the other the partnership model. The business model is a model I think that works for building value in a professional services firm. The partnership model is one that I've seen in many instances has not really worked to create value. So what does the business model look like? Take a $2 million business, professional fees, it gets expense reimbursement, and revenue of $2.1 million. What are the operating expenses for this company? Staff salary expense, partner and senior expense, rent and other non-people expense. So the initial expense of the company is $1.1 million. Subtract revenue, expenses from revenue, and the pre-tax, pre-bonus income is $1,015,000. This, to me, is the first important margin for professional services firms. And I'm fortunate that I came upon this concept in 1987. The partnership model is a little different. We generate revenue. We say that everything above, the pre-tax, pre-bonus earnings were the same. Staff bonuses were miserly. The partner pool is pretty big, and it's all paid out. Sometimes it's distributed with some difficulty, because I've seen partnerships where everyone is responsible for every good thing, and no one else or someone else is responsible for every bad thing that happened. But it's not really a sustainable model. In the partnership model, the partners had salaries of $475 and bonuses of $913, so $1,388,000. So this partnership model could be plagued by staff turnover. Sometimes the partners have uncomfortable relationships regarding the dollar splits, and it's difficult to discuss hiring and CapEx because there's a tendency to think that that hire or that CapEx is coming directly out of my back pocket. The above results then are not highly likely in my mind. The business model income statement, we got down to pre-tax. Oh, did I go the wrong way? Went the wrong way. The labor ownership split in the business model. Pre-tax, pre-bonus was 100%. We had the bonus pool of 60% of that. That's a key decision for the board or management. But try some number, create a little model like this and try some number. Staff bonuses are 40%, $243,000. Partner senior bonuses, $365,000. That leaves return to owners of $406,000. Maybe you got some taxes or a little something, a little leakage. So you've got an EBITDA margin of 19% and a distributable margin of 17.1%. In the business model, staff compensation was 300,000, bonuses were 243. So total staff compensation is 544,000, 44.8% of comp. Partner salaries, partner bonuses, 840,000, 43.5% of comp. So in terms of recap, staff compensation, partner compensation, and non-people expenses, total expenses are 1.7 million. Note that clearly the greatest expense is compensation. It's important in a professional services firm to think in terms of return to labor and returns to owners. One of the biggest stumbling blocks to creating value in professional services firms is when there is no clear distinction made between what people get paid for what they do and what people earn for what they own. So a clear distinction between labor and ownership. But in this case, the total returns to labor were 1,384,000. The returns to the owners, 406,000, and that includes partners, by the way. So 406,000, less that, we have a distributable earnings of 377,000. The key to building value in a professional services firm, in fact, in any firm, is the creation of what I have called transferable earnings. Transferable earnings are earnings that somebody else is willing to pay for. If you have a partnership that no one believes that there will be cash flow coming to them, they're not going to be willing to buy your partnership units. You have to create transferable value. The good part about business value is that, for example, assume that the EBITDA multiple is 6. 6 times 406,000 is enterprise value of 2,436. And let's assume there's no debt and cash, so that's the equity value. The business model will create business value. So partners get 1,205,000 in the business model in everything, and they get 1,388,000 in the partnership model if they can get it. But the business model creates identifiable earnings and value. It enhances staff retention. It reduces turnover, and turnover is very expensive. But the profit sharing model, at least we've got almost 40 years of that at Mercer Capital, works. You separate compensation very clearly from labor and for capital. Encourage the necessary investments because you want to make the necessary investments because that's the only way you can grow. But this is a sustainable business model. Would you rather have 1.388 million in partner compensation and little ability to realize value, or 1.2 million in partner compensation and a valuable business that can grow in value? The answer to me is fairly straightforward. There are a number of issues we've touched on with the partnership model. Staff often feels undercompensation and overworked, and turnover is high. Partners, we had someone with us many years ago who was responsible not only for his sales, but for my sales and for other people's sales as well. I mean, he really believed he was responsible. He didn't last long. But there's no insight into profitability and margins in the partnership model. And there's the only way you can create earnings in that partnership model is to do so on a pro forma basis. It's much easier if you've got income statements to show those earnings year after year. There's no implicit value attributed to the value of the firm. It's difficult to allocate equity in any sale or merger discussion. And without changing the model, there's low prospects for successful transition. That's why so many accounting firms are selling now, because they're not going to transfer internally. Profitability per partner is not a good measure of performance because indeed all partners are not created equal. And it makes no distinction between returns to labor and returns to capital. This to me is the most important thing. There are many kinds of professional services firms, business valuation, financial forensics, accounting, engineering, consulting of many stripes. But the key to creating value is to create transferable earnings that someone will buy either internally or externally. And if you create transferable earnings at a reasonable valuation, you can work on the problem of ownership succession. And hopefully that'll help you with management succession as well. Alan Colton is a comrade of mine, and he talks about things to think about as we face the changes that are coming. He says the 4 T's of growing: talent, you got to recruit and hire. I've said that earlier. Technology, you've got to have the necessary technology to do the work and to enhance productivity and foster growth. Now, transformation, you have to be able to change your business to develop it to be attractive internally or externally. And then trouble, all guys chilling has troubles. Every firm has troubles, and you have to have the capacity to address those troubles and to adapt to those troubles and stay ahead of the game. Profitable, growing firms have a lot of flexibility to deal with troubles and create successful management and ownership transitions. And that, to me, is one of the important goals of every company. So the keys to competing with top half firms in a consolidating industry: you got to decide to improve performance and value. You got to start acting like a top half firm. You got to raise the bar for your firm's performance. You got to treat your business like the business it is. I will tell you that in 1982, when I went into business, I made one of the best decisions that I ever made. When I was buying the stuff that I needed for the business, when I was beginning to try to hire people, I said, I will treat the business as a business, and I will believe that the business will take care of me if I take care of the business. So treat your business like the business it is, and recruit, hire, and train, and give responsibility to staff. You can't do it all. You have to get them here. You got to hire them. You got to train them. You got to get them experience. You got to get them credentialed. But that's all part of growing. You may say that's expensive, but that's an expense of doing business. And then specialize and market unceasingly. I think that we've done a pretty good job of that at Mercer Capital. So what's the state? Well, we're aging. The profession is consolidating. We got any questions?
We do. I don't know if you want to finish up your slide, but I probably have about 10 questions.
Well, let's just deal with the questions.
Okay, sounds
So
good.
this
Let's get
is
into it.
something what we did. This is the last slide.
Awesome. I didn't want to interrupt because you were on a roll, but okay. So, what quantitative methods do you recommend for best calculating DLOM?
Well, that's pretty easy for me because in 1997, I wrote a book that talks about the quantitative marketability discount model. I have not seen a model yet. I mean, it's a discounted cash flow model at the shareholder level. It's in valuation, business valuation, integrated theory, 3rd edition. So I recommend anyone reading that and taking it into account.
Next question. Do you believe that increasing use of calculation engagements is leading to a race to the bottom, commoditization, evaluation, and pricing of engagements?
Yes and no. Some of our better engagements are actually calculation engagements where we're working with a client to do something. But if you find yourself in the trap of saying, well, appraisal will be 10, but I'll do a calculation for you 4, that's a self-inflicted wound. And maybe go talk to Rod Burkert about that, because you can't cut prices. You have to get paid a reasonable wage for what you do. And what I tell people is that they say, well, somebody else will do this for $6,000. And I said, what's the average billing rate? And they say $200. Well, they're going to put 30 hours in it. Is 30 hours enough? Well, of course it's not. So build value rather than cut price is my advice. And build the perception of value. Okay.
Next question. As a younger person in this field, in your experience, what is the most exciting sector to specialize in?
One where you find yourself with a little bit of experience. I mean, I don't know that any industry is going to be exciting if you go deep and learn all about it. I mean, I guess maybe some tech areas of technology might be sexier than others, but basic construction can be pretty exciting if you get into it and know it well.
Which
Find one and get in it.
which one of your books is a good book to introduce to business valuation or to introduce business valuation to the university students?
That would be Business Valuation and Integrated Theory, the 3rd edition. Let's see. Right here, on the one on the right. One on your right. That's available at Wiley, and it to me, it's the best little valuation book. I say little because it's much smaller than Pratt and Trugman and Hitchner. It's the best little valuation book that most appraisers have never read. And I say that based on royalties.
Let's see. Can you spend a couple of minutes on crypto valuations as an industry?
On what?
Crypto valuations as an industry?
Well, I really can't because I have not focused on crypto yet. I would be just blabbering.
What about mom and pop shops? Are there any consumers that don't want to pay top dollar at those large firms?
And for mom and pops, the small firms,
Uh-huh.
well, many times they don't want to pay they don't want to pay for it. My suggestion is that I've been selling the concept of recurring valuation for decades. First off, if you're a profitable company and been in business a while, you might need an appraisal every year. In my book, Unlocking Private Company Wealth, I talk about that at some length. So I mean, I think some people don't want to pay it, so tell them you'll do it every 2 years. Tell them you'll do it every 3 years, but do it. And I used to say years ago, I said that obtaining an annual valuation was good for companies, and I thought it would be good for my business. We've been in business 42 years, going on 43 years, and we have valued hundreds of companies on a recurring basis. What I can tell you is that annual appraisal is good for the companies. It facilitates transactions, it facilitates planning, it facilitates ownership and management succession. And it's a concept that we as appraisers need to get better and better and better at selling.
I know we're at time, but do you still have a couple minutes
Sure.
for questions? Okay. And I know if people have to leave, that's totally understandable. I just want to let you know that you can download the presentation from the email that I sent you this morning. There's a link for you to download, and you will receive CPE. It should pop up on your account in about a week. But if you want to stay on for more questions, please do. Okay, so next question. Can you speak to compensation for newer entrants into the profession?
You got to pay market. You got to make it attractive for them. If you you got to understand and find out what the market is for that level of people, because that is the key to building a sustainable business, is having people that will come into you, will appreciate working there, and will in all hopes stay with you for a good long while. I mean, our average age at Mercer Capital is about 35, 35 or 36. And that includes me in there. So as opposed to 53 or 54 for the profession in general. And as we've hired people, we've paid them market wages, and we've tried to retain them, maybe above market wage if we're profitable, because we're a profit sharing company.
How will things look like for a single practice owner?
How do you look? If you say that again, please.
How will things look like for single practice owners? And that might have been more going back to a slide. I'm sorry.
Does that mean by myself? That's how I started, and you know, I worked diligently to move beyond that as quickly as I could. I did so because I was willing to reinvest cash flow by hiring people and by buying the things that I needed for the business. And now, fortunately, the business does a good job of taking care of its owners.
Is there a certain critical, oh, sorry.
It's an attitude.
Is
Yeah.
there a certain critical mass that firms need to achieve to be attractive for consolidation?
Well, what's important to be attractive for consolidation in one form or another is that you have a company that has identifiable earnings, that has some track record that might look good, and you can show that you have created transferable earnings. And that might be with 4 people, you know, doing $1 million a year, or it might, or whatever the numbers are, might be with 8 people, it might be with 10 people, but some of the companies that are being acquired now are relatively small.
Okay, sorry, just scrolling. Is there a certain critical, oh wait, no, that was the same question. Do you agree that focus on litigation related areas as a niche with AI is better area than fair value for reporting or even for tax purposes?
Well, we do fair value work at Mercer Capital, but if there's an area where there might be a race to the bottom, it's in that arena. I think litigation in a given market, or litigation if you have a specialty for an industry, can be quite attractive. I don't know about AI. That's part of the deal, but I mean, you've got to create the kind of reputation and the kind of belief that people want to hire.
All right, and then last question. Have you ever lost a pickleball game?
Oh my God, yes, many, but I have never lost a pickleball game and still not had fun.
That's good.
Every time I play pickleball.
Well,
Yeah,
thank you so much, Chris. That was all the questions. I don't know if you have a couple things left to say to wrap it
no,
up, but
I think we're done.
awesome. Well, thank you so much, and thank you everyone for attending. Please fill out the eval link and the email that you received this morning. We always appreciate your feedback.
Well,
Thank you, everyone.
I'll send you that ready for sale comment, and if you want to send it to people if they want it,
Yeah,
that's okay.
I can send it out. No problem.
Okay, perfect.
All right.
All right.
Thanks, everyone. Bye.
Okay. Bye.